Millions of people are opening their credit card app and seeing a number that's suddenly smaller than it used to be. No warning, no explanation, just a lower limit than they had last month. It's happening across the industry right now, and most people have no idea why or what it actually does to their credit. Credit card companies aren't required to keep your limit where it started. Common reasons for credit limit cuts include missed payments, high credit utilization, account inactivity, and issuers taking proactive measures during periods of economic uncertainty. Even people who've never missed a payment are getting hit. Issuers watch broader risk signals across the economy, not just your individual account. Rising inflation and recession fears push issuers to cut limits to reduce their own exposure, the same pattern that played out during the early days of the COVID-19 pandemic. This is not personal, it's a portfolio-wide risk decision, and your account can get swept into it, even with a clean history. Here's why this actually matters beyond just having less spending room. Your credit utilization ratio, the percentage of your available credit you're using, is one of the biggest factors in your credit score. If your credit limit gets cut, your utilization increases automatically, even if your spending habits haven't changed at all, because the math is based on the ratio between your balance and your limit, not your balance alone. A balance that looked healthy at 20% utilization can jump past 40% overnight, just because the limit underneath it shrank. If this happens to you, the first move is to call your issuer directly and ask why. Contact your issuer immediately. Ask for the specific reason behind the cut, confirm your personal information is current, and focus on paying down existing balances. Sometimes the reason is something fixable on your end, like account inactivity, in which case simply using the card more regularly can help restore it over time. While you're on that call, it's worth asking whether the reduction can be reversed, especially if your payment history is solid. Issuers don't always advertise this, but they will sometimes restore a limit if you push back and demonstrate you're not the risk their algorithm flagged you as. There's also a defensive move you can make elsewhere in your credit profile. Requesting a credit limit increase on one of your other cards can help offset the damage. Even if this account got cut, raising your limit somewhere else brings your overall utilization back down without you having to pay off debt faster than you can afford. And if none of that works, the last option is simply paying down your balances directly. Bringing your balance down proportionally to match the new, lower limit keeps your utilization ratio in check, even though the limit itself didn't change back. This isn't something you did wrong. It's how the credit system manages risk during uncertain economic periods, and it's happening to people with strong credit right along with everyone else. The move that protects you isn't panic, it's checking your utilization, calling your issuer, and adjusting before it drags your score down with it. If you want to understand the rest of what actually moves your credit score, I broke down the full system in an earlier video, link in the description, and subscribe to leverage your money for the next one.